Good morning and welcome to the Interactive Brokers Studio, where we'll be talking about the Consumer Price Index and waiting for the numbers as well as the associated market response. The expectation is for 3.4% year over year. That's lower than 3.5% back in June and slower, of course, than May's 4.2%. Here in our prediction markets, however, there is only a 13% chance that we're going to see a number ahead of 3.4%. That contract is going for 13 cents right now. A number above 3.5 is going for 8 cents. A number above 3.3%, 56 cents. So here in the Interactive Brokers Prediction Markets, we're seeing that participants here generally expect a lighter than expected number. Of course, yesterday we saw that Treasuries saw a relief rally driven by optimism concerning the U.S.-Iran negotiations. However, today we're seeing another rebound in Treasuries. We have the 10-year down to 4.66 and the 2-year down to 4.19 prior to the CPI. However, oil prices are still going higher at $84. So this same disconnect we saw yesterday, we're seeing it again today. The Treasury market is more optimistic about the geopolitical situation than the actual commodity market because oil prices are increasing. We'll see what this number does to Fed hike expectations for next month. Here in the Interactive Brokers Prediction Market, the odds of a steady Fed are at 60%. And the odds of a 25 basis point hike is 37%. So still the market is expecting Fed Chair Warsh and the committee to stand back and not enact a move on interest rates. Here, however, in the CME's FedWatch tool, odds of a hike are a little higher at 46%, odds of a 25 basis point hike. Whereas here in the Interactive Brokers Prediction Market, it's at 37 cents or 37%. So a little bit of a discrepancy, not much. Yesterday's economic data also supported the drop in interest rates and a Treasury rally. You see here the private sector hiring numbers. Give me a second. I'm hoping that my screen is being shown. Bear with me for one moment, ladies and gentlemen. So this Treasury recovery was driven by private sector hiring decelerating to a really worrisome pace, the 7th consecutive week of deceleration, down to 8.3 thousand for the week ended July 25, 2026. This is a new ADP number. It's a weekly number of the weeks. And Andrew Wilkinson is here. Welcome, Andrew.
Morning, Jose. I've been flipping between channels looking for you. I couldn't find you. There you are, finally.
Welcome. Good morning. I'm hoping that my screen is being shown, or that can you see my screen?
Not yet.
No. Well, yesterday's data showed private sector hiring decelerating to a worrisome pace, down to around 8.3 thousand. That also supported yesterday's Treasury rally. And today, I was telling the audience, Andrew, we're seeing the same kind of discrepancy between the rates market and the commodity market as it pertains to a geopolitical situation. So rates are down, but oil is up prior to the CPI print.
Yeah, this is the war that won't go away, isn't it? So we've got very sticky crude oil prices. They tumbled. We've kind of been it's just a theme that we keep getting told the war's coming to an end, talks are progressing, but they're not. And so crude oil keeps falling, then it keeps rallying again. So we seem to be stuck with elevated gas prices and other energy and commodity inputs. So yes, a little worrisome. And you're saying it's beginning to have an effect on the labor market, Jose?
Yes, that is correct. We're starting to see that we saw non-farm payrolls, for example, contract last Friday. Of course, we were reporting here live for that. Sorry, folks, not sure what's happening with the screen share. We'll just leave it off for now and do the best we can. We got that non-farm payroll decline. That was a big contraction. Now with these ADP numbers nearing monthly totals are around 32,000 or so. Yet last month's ADP number for the monthly was up at 40,000. We're seeing this real clear deceleration in the labor market, really a supply story, demographics, immigration. We spoke a lot about that in last week's live stream. Don't want to repeat a lot of the same information, but an interesting dynamic was that ADP's wage pressures were strong while BLS's wage pressures were weak. Also, elevated mortgage rates and record high prices drove a slip in existing home sales yesterday. That also served to drop interest rates, albeit not as much as the ADP weekly numbers or the optimism about the geopolitical situation. And then we also did see, however, that small business optimism jumped to the highest level since August on stronger hiring and capital expenditure plans. Markets right now are much higher, about 23 basis points, I should say, which is I would say that's much higher prior to an economic data print like this, because usually you're kind of flat. But you had some strong earnings from CoreWeave and Super Microcomputer, well-received profitability reports. And, folks are jumping ahead and looking to buy this market prior to this CPI report.
So Jose, you've been writing about the forecast market, the expectation for today's number. Well, first of all, what are we expecting on a monthly basis for the CPI? And then what are we expecting for core CPI?
Yeah, so that's actually the key element that I've been discussing, is this huge gap between the headline CPI and the core CPI, which bodes well for bond buyers, bodes well for monetary policy doves. And folks that think that this geopolitical conflict couldn't be reconciled soon, essentially headline CPI would have to fall a lot closer to core. And right now the spread is around 90 basis points. The expectation for headline is at 3.4%. Expectation for core is down at 2.5%. So when you look at core, you're not that far from the Fed's 2% target. However, when you look at headline, you're miles and miles away. And that's why this geopolitical situation is so important, because if you can find a solution that subdues oil prices, even if it stays in the low 70s, albeit the 60s would be the most desirable result, I think. If we see that, then this headline CPI is back down to the low twos by year end, call it 2.4, 2.3.
What explains for that big almost 1% gap between the two, Jose?
It's really the housing element. The housing market is so weak right now, Andrew, and it has to do with elevated mortgage rates, but it also has to do with rising vacancies in the rental markets. You don't have the immigration flows that you had a few years back. So that, combined with high interest rates, are lifting vacancy rates. That's weighing on rent growth, compressing landlord margins, weighing on apartment building valuations. And then those same valuation structures and those same rental figures, that momentum starts to translate over to the single family market. And for that reason, housing, shelter makes up almost 40% of the CPI. It's the biggest basket. And in the core CPI, when you exclude food and energy, it makes up even more, of course, because without food and energy, that means housing and shelter gets weighted more. So that's why you have core so weak, but headline so strong.
So not a good time to be a landlord?
Not a good time to be a landlord, no, because, or to be a new landlord even, because rates are through the roof. So if you want to buy a new property, immediately your cost of carry, your mortgage payments, your insurance, all your costs, are quite elevated, while your revenue prospects are not that buoyant. In fact, a lot of areas around the country are seeing outright rent declines, outright valuation declines. So, going into an expensive market and then not having the revenue buoyancy, it's not a great time to be a landlord now.
So what's the likely impact on financial thinking as a result of today's number?
I think that the September pause is going to remain. Now that you have evidence of contracting payrolls, and folks, that's the big threshold, right? Once you go below zero, irrespective of why payrolls are decreasing, you are now becoming more anxious about a potential economic slowdown, because if less folks are working and that becomes more of a commonality across the economy, meaning that in the next, let's say, 4 months, two of those four or three of those four reflect contracting payrolls, now your recession risk has to be incrementally higher just based off of that. Again, irrespective of why payrolls are contracting. And due to that dynamic, folks are the Fed is now has to turn away from its unwavering attention to price pressures and start to increasingly consider the employment side of the mandate. Even though you've been above target for 5.5 years, Fed Chair Warsh has wanted to maintain a focus on inflation. He feels that the prior regime was too focused on suppressing volatility, maximizing prosperity, and maximizing employment health, with the cost being inflation. He's been focused on inflation, tackling that issue that he feels that his predecessors were not doing properly. However, now with this labor market weakness, now there has to be a tilt the other way. So if his focus was on price pressures, call it 85% to 15%, now I think that has to come down to 75-25 at the most hawkish level and 60-40 at the most dovish level.
Just a reminder to the audience before we get Jose to talk about the prediction market odds on today's numbers. You can direct questions to myself and Jose on X and LinkedIn. So look for the Interactive Brokers channel there. Jose, how are you getting on with your screen share? It did come up when I joined, by the way.
Oh well, I've been trying, but we're gonna have to we're gonna have to talk to
There it
okay,
is.
I think we are here. Okay, great. This is great.
I bring you
Thank
good
you.
luck.
Thank you. Yes, you do. Yes, you do. And you know what? Without you, I'm lost.
All right. So tell us about the prediction market odds going into this number.
Yes. So, yeah, I thought that this 3.3% yes was undervalued. It was the contract that I wrote in my recommended opinion yesterday. Expectation 3.4. So this 51 cent should be at the 3.4 level, more or less. Because if you get an inline number, 51 cents becomes $1. That's what we're expecting. In the Interactive Brokers marketplace, we're expecting 3.3, but the economist consensus estimate is 3.4%. A hotter number here at 10 cents, 3.4 would earn $1. So that's a 10x kind of return. Fed expectations, 37% chance of a hike, 60% chance of a steady number, similar to the CME, albeit it's a little more hawkish with a 46% chance of a hike. Quick look at the charts from yesterday: private sector hiring, existing home sales, and small business optimism. Let's see what's going on with the number. Yields are down 3.4%, so exactly as expected.
Okay, so all items 3.4%, which is a 0.1% rise in July. And what else is there? Energy as a group was up 14.7% year over year and down 1.5% for the month. Gasoline prices were also down 2.9% for the month there, but still almost 25% higher. The all items less food, Jose, 0.2% on the month and 2.5%. So as you indicate, and about 90 basis points between the headline and the core. Take it away. What are you seeing?
Absolutely, yeah. Seeing the shelter number here, 2 months in a row, 0.1% month-over-month growth. That's anemic when you look at the past 5 months before that, where you range between 0.2 and 0.6%, looking like an average of around 0.3 or 0.4. So down at 0.1, we're a lot weaker, and that's that element we were talking about, that rate-sensitive, immigration-sensitive housing sector. Transportation services still up 0.3%. Even though gasoline and fuel were down. So we'll have to look later to see if that's more about airfares or car insurance, medical care up 0.6%, apparel up 0.1%, used cars 0.4%, new vehicles 0.1%, food away from home up 0.3%. However, food at markets down 0.1%. Pretty good a report overall, not that much inflationary pressure. Of course, the year-over-year number lifted by the energy being up 14.7%. Expecting this year-over-year shelter number to start to decline into the twos soon. That'll be helpful. Used cars on annualized helping down 0.19%, offering some deflationary pressure. But folks, 0.1% month over month, that is a very, very good inflation trajectory. And I think that's why, we had the market here, a little bit of a hesitation, but still up 31 basis points. We traded down on the S&P to 7740. These numbers, we move up so fast these days. And then we moved up to 7762. So looking up around 32 basis points, yields down, dollar lower, oil still higher. Let's see what precious metals are doing. Here is gold up 1%, silver up 2.5%. Probably means that the Fed curve is getting more dovish.
Yeah, it looks like quite a positive response to this, Jose.
Yeah, hike now in the CME down from 47 to 44, so 56% chance of a pause. And we're going to look deep into this number while we present you with Chief Strategist Steve Sosik. He's going to explain prediction markets with our Director of Trading Education, Andrew Wilkinson.
What exactly are prediction markets?
Prediction markets are a way for ordinary investors to express their views on market-related events, some of which have very important consequences for one's investing. For example, we all know that elections have ramifications for markets. With midterm elections approaching, it will be very easy for investors to decide who they think has the better chance of taking the lead in the House of Representatives, the Senate, or in any range of specific congressional or gubernatorial elections. Prediction markets make that very simple. You can speculate on these races, or you can effectively use them as a hedge on your investment positions, but doing so in a much more targeted way than one was able to do before the advent of these products. This, to me, is the beauty of prediction markets. You can express a view on something that is market related or investment related, but that has always been historically difficult to factor into prices in a direct manner.
Walk us through the mechanics. How does one trade?
In terms of the mechanics, it's really not that difficult. You buy the yes if you think that the outcome of the contract will occur. You buy the no if you think it won't. And you also exit your contract by buying the opposite contract. So if you're long a yes, you buy a no. If you're long a no, you buy a yes.
Then how does one calculate profit and loss?
Prediction markets are quite straightforward. They trade at a value between 0 and 1. And these are dollar contracts, so you can speculate a little more in terms of the number of contracts because the dollar value is low. And in terms of their percentage return, that's based on what you paid and the difference. So the leverage can be quite powerful because if I pay 40 cents for a given contract and it resolves at 1, I made 60 cents on my 40-cent investment. That's 150% return.
And what are some risk considerations?
One thing that we believe mitigates the risk is that these are financial contracts, not bets. These are financial contracts by a reputable financial firm with important financial regulation behind them. We believe that these prediction markets are a valuable tool for investors to speculate on or hedge risks that otherwise have not been easy to incorporate in one's portfolio. And that's why we feel very strongly about these products as investment tools and risk management tools rather than just purely speculative instruments.
I'm still taking notes, Jose.
Yeah.
So food at home up 2.7% year over year, and fruit and veg up 5.1% year over year, and non-alcoholic drinks up 4.1% over year. What are your thoughts on food prices? Food away from home up 3.4% compared to a year ago.
Yeah, I mean, we see that the airline. I was on the month over month with the airline fares, 2.2%. That rose irrespective of the decline in oil prices. I think that could be partially the World Cup demand and strong, still robust shopper strength in terms of spending and expenditures. Big discretionary category up 2.2%. Motor vehicle maintenance and repair came in at 0.6%. Tobacco and smoking products 0.5%. Hospital 0.5%. Cereals 0.2%. Alcoholic beverages 0.2%. Physician services 0.2%. And then when we go into the negatives, we have food away from home, food at home, which is essentially food from the store, from the supermarkets, down 0.1%, dairy 0.1% down, fruits and veg 0.1%, car insurance down 0.3%, medical care commodity 0.6%, meat, poultry, fish and eggs 0.7%, and yeah, so pretty good report overall.
And lodging away from home, I noted, was as you were saying. I just lost that one on the screen. No, I've lost that place on the screen, but that was a down month year over year as well, just to underscore the point you were making earlier on. Okay, so is this a big is there a big sigh of relief from investors getting this report out the way?
I don't think so. I think that the geopolitical situation is still top of mind. And now we're moving into a realm where inflation can start to flatline from here, because we're going to look at the Cleveland Fed nowcast in a second, but it's at 3.4% for the month of August. So if energy prices don't start to cool, or if they stay where they are, there's a chance that can go up to 3.5, and we're back on an acceleration path. So that would certainly not be good. I think the focus for markets are squarely on the geopolitical situation.
Gotcha. So we're moving on to tomorrow's report on producer prices. Give us your thoughts on that. How important a report is that? That's to me, that was always kind of played second fiddle to consumer prices, because it's an input. Some of those input costs get absorbed by manufacturers and producers and so on. But it is an impending sign of what's coming down the pike, is it not?
Oh yeah, definitely. That's actually expected to increase 0.2% month over month or year over year. Level of 4.9%, which is down from 5.5%. The previous report reflected a 0.3% decline. So looking to get some of that back. However, this print is energy and food sensitive. So with food and energy down on the month over month, food at home, and energy down on the month over month in the CPI, it's going to be interesting. I think that the bar is going to be too high here for the PPI. I think that you should be looking for a flat number at the hottest or a lower number. PPI has been historically much more difficult to forecast than the CPI, just because there's a lot of stages on the supply chain, a lot of different, wholesalers. There's intermediate demand and final demand, and predicting all those inputs, are a lot harder than just predicting what consumers pay. But I think that for PPI, I think that the expectations are pretty lofty at the 4.9% level. Let's see what the pricing in the prediction market shows, because maybe there's an undervalued contract, in my opinion, that investors could look into. Yeah, so right off the bat, this 50-cent no at 4.8. I think that we're going to get a lower than expected number. Expectation is 4.9, but if you go to 4.8% or lower, this 50 cents would pay off $1. So, I'd be in favor of this 4.8%. I think I'm going to write about that later in my daily forecast contract report.
And that's available at the Interactive Brokers campus under the education menu. Look out for Traders Insight there. Gosh, that was almost like an advert, Jose, but I didn't plan it, did you?
I did not. Markets are running further now, Andrew, to the highs of the pre-market up to 77.62, all-time highs around almost at 77.94 area, almost at 7,800. This is traditionally a weak seasonal period, but folks are buying. Folks like what the Trump administration is doing in terms of supporting the animal spirits and intervening in Japan and trying to keep interest rates low and keeping the pro-business agenda and communicating positive messaging on Iran, even if a deal isn't imminent at all. Hope for a deal has been ongoing since March.
One thing that strikes me in this entire war, Straits of Hormuz is practically closed. It remains closed fairly much, right? I think we can agree on that. Isn't it remarkable that the price of oil is as subdued as it is, that it's south of $100, given what's gone on? It's kind of hopium is keeping crude oil prices under 100, I would say. Yet in actuality, we're still not getting much crude through, right?
Yeah, no, we have the shock absorption of the economy has really been built up over the years. You had Russia's invasion of Ukraine, that really had the Europeans, compelled them essentially to get into a mindset of energy scarcity and energy security being a predominant theme across nations. So China, of course, huge importer. They have a lot of storage of barrels in their backyard. U.S., we've been bringing down our strategic petroleum reserve. I want to say down to the lowest since the 1980s. So those draws have been significant. So there could be a time where you actually do see real energy scarcity. We just haven't gotten there yet, and I think that we can probably go a few more months without having to deal with energy scarcity. There's also a lot of pipelines being built and things that probably aren't presented in the news or available to us that are being done behind the scenes to make sure that energy is available.
Gotcha. Zachary has just written in here, not so much on today's report, but a general question for you. And I was talking about this with my editorial team earlier in the week. He says, thanks for the breakdown on the CPI. You're welcome. I'm just taking words out of your mouth there, Jose. He said he thinks it's going to be interesting where the Berkshire Hathaway, Warren Buffett cash pile gets dispersed to. And I was noting and having a conversation with some colleagues who were writing about this. What are your thoughts on this? Whatever Berkshire Hathaway is going to do with its cash pile, where we're pretty much at a market high. What are your thoughts on that juxtaposition?
Yeah, I think forever the firm has been a value investor and has looked to price to earnings multiple and cash flows and subdued price to book multiples as ways to invest. But that era has been essentially behind us for quite some time. Really since the great financial crisis era, we've been running up multiples, and the growth sector of the market has really outperformed. And the economy is totally different now. It's much more technologically based. It's less capital intensive, albeit the AI theme is bringing a lot of that capital intensity back, but still on balance, less capital intensive than it used to be. And I think that cash is going to have to be deployed into more of the Magnificent Seven stocks, which is a breakaway from the traditional Berkshire Hathaway traditions. However, these firms are now becoming really integrated into American society, into the governments all around the world, and into human everyday life. So I think that there's attractive multiples in the Magnificent Seven, some of those stocks that from a traditional analysis perspective on how Berkshire likes to look at things isn't necessarily that attractive. However, in a more modern framework under a new CEO, that mindset could change, and I expect that money to go into Magnificent Seven stocks.
I'm thinking more utilities, but what do I know? Just wondering if
Well, energy is not bad if you're looking for dividends and share buybacks, and you don't think that that fossil fuels are going away in the next 5 years. Energy, which I don't think, then I think energy is a good play as well. And you have a lot of cash being returned to shareholders via buybacks and dividends. So that could be an area where they go into too.
Well, the other thing you pointed out on the live stream on Friday, Jose, when payrolls were published, the construction sector picked up jobs again, and the housing market's not so clever. Your suspicion was that this was to do with the build out of commercial real estate and in particular potentially data centers.
Oh, absolutely. The home builders, they haven't been active. We've been seeing the starts numbers, the permits numbers very subdued. And, for obvious reasons, no one can really get the sales momentum with these rates this elevated. And, those construction projects are really all going to the data centers and the infrastructure associated with artificial intelligence. That being said, there's also that part-time aspect of construction where folks could get double counted. If they work for Wilkinson Construction Corporation and Torres Construction Corporation, then that counts as, 2 jobs, even though the employee is just one person. So,
Gotcha.
that could be happening too, because you do have that part-time nature in construction, like you also have it in leisure and hospitality.
Brilliant. Okay. So a subdued report is leading to market action in the flavor of what this morning? We've got a weaker US dollar. The pound is currently trading at about 135.32. That's up on the day. The euro is trading at 115.57. And equity index futures all trading higher and yields lower. So what are you going to do for the rest of the day, Jose?
Yeah, we're going to write about the CPI. We're going to write about the market response. We're going to talk about tomorrow's contract pricing for the producer price index. And we're also going to get ready for tomorrow's live stream on producer price index. That'll be in Spanish. And that'll be after a CNBC live interview at 5:45 a.m. with Morgan Brennan up in the CNBC studios in New Jersey. And then I'll be close to you tomorrow after that interview at 8:30 in Greenwich, Connecticut. So a lot of things happening in the next few hours. But we're looking forward to seeing tomorrow's PPI live stream will be in the Spanish language. We have the 2 English live streams and we have the 1 Spanish live stream. We do have a big Latin American audience. Of course, our business is very international here at Interactive Brokers, and we pride ourselves on having transactions for all different financial products coming from all different continents and all different countries. So, that's part of why we expanded our coverage to the Spanish language as well.
Yeah, and don't forget to check us out at interactivebrokers.com. You'll find the prediction markets there and even how to open an account. So, Jose, I'm going to say thank you very much for taking the time today. And since I no habla español, I will not be joining you tomorrow.
Yes, that is true. But we will see you next month, as well as we'll see you in many of our other programs and podcasts and webinars that we have in IBKR campus. Tomorrow, the host will be, as always, Judy Casasampere, Institutional Sales, West Palm Beach, Florida. Andrew Wilkinson, thank you so much for hosting today's program.
Thanks, Jose. We'll see the audience later. See you tomorrow.